Good morning and welcome to TOITOI Japan Market Radio for February 19, 2026. I'm your host coming to you from Tokyo. This is the daily briefing designed specifically for global investors tracking Japanese equities, currency, and rates. Let's dive straight into today's session.
Thanks for having me. Today's session in Japan showed fairly broad-based strength. The Nikkei 225 closed at 57,467.828, up 0.567%. The TOPIX performed even better, finishing at 4046.0, up 1.226%. The Mothers Index gained 1.536% to 2,379.0, while J-Rights pulled back slightly, down 0.612% to 2029.0. On the currency side, dollar-yen moved to 154.806, which is up 1.082%, so the yen weakened notably today. Gold in yen terms surged 2.506% to 18,410.0, and crude oil rose 1.411% to 66.11.
So we're looking at a risk-on tone in equities, particularly in the broader TOPIX, but the yen is weaker and gold is rallying quite hard. That's an interesting combination. Let's unpack what's driving this. We saw a headline today noting that the Nikkei climbed just over 1% with TDK Corporation surging by 6.73%. Can you walk us through what happened there?
Absolutely. TDK is one of the heavyweight components in the Nikkei, a major player in electronic components and advanced materials. A single-day move of 6.73% is quite significant for a company of that size. It signals strong investor confidence in Japan's industrial electronics sector, which remains a critical export driver. This kind of outperformance typically reflects optimism about global demand for tech components, particularly in areas like automotive electronics, sensors, and battery technology. For Japan, this matters because the electronics and components sector is deeply tied to export competitiveness and overall economic growth.
And in terms of market impact, are we seeing this strength spill over into other names in the sector?
Very likely. When a bellwether like TDK rallies sharply, it often encourages rotation into related names such as Murata Manufacturing, Kyocera, and even Sony on the consumer electronics side. The broader TOPIX outperforming the Nikkei today by more than 60 basis points suggests that the rally wasn't just concentrated in a handful of index heavyweights. Export-sensitive sectors benefited broadly, which is consistent with the weaker yen we're seeing. On the currency front, this risk on sentiment typically pressures the yen as investors rotate into higher-yielding or growth-oriented assets. So the move to 154.806 in dollar-yen makes sense in this context. As for JGB yields, we'd expect them to be stable to modestly higher as equity strength reduces safe haven demand, though the Bank of Japan's policy stance remains the dominant driver.
Staying with that theme of technology and the weaker yen, we also saw reports today that Tokyo stocks closed higher specifically on the back of tech shares and yen weakness. It sounds like those two factors are reinforcing each other.
Exactly. The technology sector in Japan is highly export-oriented, so a weaker yen directly improves the profitability of these companies when they convert overseas earnings back into yen. This is a classic tailwind for Japanese exporters, whether they're in electronics, autos, or machinery. Today's session reflected that dynamic quite clearly. The tech-heavy indices outperformed, and the combination of sector strength and currency support provided positive momentum across the board. For global investors, this suggests improved sentiment toward Japanese equities despite the broader macro uncertainties we're dealing with globally.
So if this weaker yen trend continues, we should expect further support for exporters?
In the near term, yes. A sustained move toward 155 or beyond in dollar-yen would be incrementally positive for Japanese exporters, particularly those with significant revenue exposure to North America and Europe. However, it's worth noting that a weaker yen also increases import costs, especially for energy and raw materials. That can weigh on domestic consumption and margins for companies that are more domestically focused. So the net effect depends on the sector and the company's revenue mix. But for the major indices like the Nikkei and TOPIX, which are heavily weighted toward exporters, a weaker yen is generally supportive.
Now, shifting to a geopolitical theme, we saw analysis today from MUFG warning that the Japanese yen would take a hit if the United States were to launch a military attack on Iran. This is a significant scenario to consider. Can you break down the logic behind that call?
Sure. MUFG is highlighting two key vulnerabilities for Japan in the event of a US-Iran conflict. First, energy security. Japan imports roughly 80% of its crude oil, and a meaningful portion of that comes from the Middle East. Any disruption to oil supplies or shipping through the Strait of Hormuz would directly increase energy costs for Japanese industry and consumers. That would be a significant headwind for growth and corporate margins. Second, and perhaps more immediately relevant for markets, is the behavior of safe haven flows. In a geopolitical crisis, capital typically flows into the US dollar, Swiss franc, and gold. The yen, despite its historical safe haven status, could actually weaken relative to the dollar in this scenario, especially if the conflict is centered in the Middle East and oil prices spike.
That's counterintuitive for many investors who think of the yen as a safe haven. Why would the yen weaken in a risk-off event?
It's a fair question. The yen does act as a safe haven in certain types of risk-off episodes, particularly those involving global financial stress or European instability. But in scenarios where the US is directly involved militarily, the dollar tends to dominate as the ultimate safe haven. Additionally, Japan's heavy reliance on Middle Eastern energy makes it structurally vulnerable to this type of geopolitical shock. Higher oil prices would worsen Japan's terms of trade, increase the current account deficit, and put downward pressure on the yen. So in this particular scenario, MUFG's view is that the yen would weaken rather than strengthen. For equities, the impact would likely be negative, especially for energy-intensive sectors like transportation, chemicals, and utilities. Exporters might get a small boost from a weaker yen, but the overall risk-off sentiment would probably outweigh that. On the rate side, you might see modest upward pressure on JGB yields as investors rotate out of Japanese assets, though demand for JGBs as a regional safe haven could provide some offsetting support.
So this is a scenario where both equities and the currency could come under pressure simultaneously.
Correct. And it's worth noting that gold in yen terms already rallied over 2.5% today to 18,410.0. Which suggests that some investors are already positioning for heightened uncertainty. Gold in yen terms is a good hedge for Japanese investors against both geopolitical risk and yen weakness. So today's move might be an early signal of that kind of positioning.
Let's pull all of this together for our listeners. We've got a strong session in Japanese equities today, driven by technology and a weaker yen. TDK's outperformance is a positive signal for the industrial electronics sector. But on the horizon, we've got geopolitical risk tied to the Middle East that could put pressure on both the yen and equities if it escalates. How should global investors be thinking about Japan exposure right now?
I think the key is to recognize that Japan remains an export-driven market, so currency moves matter a great deal. The current environment, with the yen above 154 and tech demand holding up, is supportive for Japanese equities in the near term. But the geopolitical backdrop introduces meaningful tail risk. If we see escalation in the Middle East, Japan is more vulnerable than many other developed markets because of its energy dependency. So investors should be monitoring not just domestic data and Bank of Japan policy, but also oil prices and geopolitical developments in the region. On the positive side, Japan's corporate sector continues to show resilience, and the tech-led rally today is a reminder that there are structural growth drivers here, particularly in semiconductors, components, and advanced manufacturing. It's a market that requires active monitoring, but the opportunities are real.
Well said. For those of you tracking Japanese markets or managing Japan exposure in your portfolios, I hope today's discussion gave you some useful context. If you found this briefing helpful, please consider subscribing to TOITOI Japan Market Radio. We'll be back tomorrow with another update. Thanks for listening.
Thank you.